Good afternoon, folks. Welcome to Green Bicep, episode number 1, where there's signal, no noise. Cycles repeat. Well, you know that. 2020 was an anomaly, but a cycle was leading up to it. 2008, 2020, 1998. Go back, 92. 87 crash. You got 79. We will provide signal for cycles so that you are prepared before a cycle happens and occurs. Let's celebrate together. My first unofficial sponsor. Not bad. So we will talk the stock market, bond market, FX, commodities, and real estate, all markets. Fundamentals, technicals. I'm going to have an educational side. We're going to have a scorecard, what to buy, what to sell, real high level, long-term trends. Also deep dive equity valuations as well will be added at a certain point. Today, we're going to focus on what is happening, signal. Okay, let's do this. Where is my friend? Here we are. I guess wherever I move that screen, it follows. So, woo, what is this? Let's pause, and we're not gonna quite get into the VIX quite yet. But if we did, we could see, looking at cycles. We know we had a 2000 crash. We know we had the 2008 crash. We had 2020 crash, and now we have the Federal Reserve raising rates. So this is high level cycle looking at the VIX volatility. The focus is not that for this, for specifically what we're talking about. We're going to talk about 3 components. You have growth, inflation, and interest rates. Those are key currently today. And that is what the Federal Reserve is trying to manage, ultimately, trying to stay in that realm of being able to control these things so that they have a smooth glide path. The 1977 Reserve Act, Reserve Reform Act of 77 essentially said stable, full employment, and it basically targeted 2 things, unemployment and inflation, but that was in 1977 that came out. All right, GDP. So looking at gross domestic product, that's just essentially how much is produced and sold to the end user in the United States of America. We are currently at 7.3% growth. Everybody's talking bear market. What bear market? We're at 7.3%, and you can see that right here. Boom. So things are going pretty well in the United States. Currently looking at historical data, but it's happening, meaning that is real 7.3. Secondly, employment. Look at this, 154 new jobs created in the month of November. That's pretty good. Solid uptrend. Where's this recession everybody's talking about? Do you see why not? Let's look at 10 years. Yeah, it's interesting. We're much higher than pre-2020 and going back to 2013. And yeah, wow, new jobs created, pretty good. Averagely hour earnings, high, turning over. Growth, inflation, interest rates. This is a problem. The Federal Reserve does not want to see too much wage growth. More than 2.5%, 3%, nada. And this is a problem. And this is their target currently. This is just ancillary. Just shows us cycles. We're talking about cycles here. When Civil War, debt was high in the world. World War I, debt was high. And then obviously you see Great Depression and crazy amount of debt in World War II. And then 2008, we had the pandemic. And now we are present. I don't know why this is not updated later. But anyhow, updated is through 2020. The point is there's a lot of debt held. So debt is something you have to watch because ultimately the Federal Reserve has to manage around debt for, well, the government has to, but ultimately they have to work together as a team regardless of what people think. So debt is high, so that's the issue. So you have growth, you have inflation, right? And you have interest rates. So we need growth to continue to be high. Gross domestic product, 7.3%, in order to pay off our debt. Why is that? Because if we could have a high enough growth rate, peg interest rates at a low rate, then we could refinance our debt and pay off old debt. And that's ultimately what the Federal Reserve is trying to do, and they potentially might be able to do this successfully. Amazingly, right? Next, you get into single-family housing starts. What's going on here? Why do we see this downtrend? You see it, I'm sure. I see it. Right here. Oh, my apologies. Anyhow, the downtrend starts basically in 2021 all the way down to July. So single family homes has started trending down in January when the interest rates started skyrocketing in the United States of America. So that is a negative. Going over max data going back to 1960, you could see that we are well below trend. In population growth, we need to maintain probably close to 1.2, probably more than that per year to have homes for everybody. Otherwise, you could have apartments. So there's a shortage of housing. That's part of the reason why prices are going up. Plus, everybody's moving from the Northeast and Midwest and or more like from California, away from California, New York, and those states. High taxes, low taxes. So there's a great migration going on as well. So there's a combination of factors. And so housing long-term is a good play. But saying that, short-term, it has turned over. Housing leads the market. If the housing goes over, the market will go over. So this would say you should be bearish. This means move your money to cash now. It's not too late. Secondly, what is this? This is housing starts as well. We'll skip over this. Next, we're looking at the NHA. This is a index by the home builders, the corporations that manage billions of dollars. Pulte, D.R. Horton, you name it, the big guys. This is their survey. It's 31. That's, well, let's just get through. In January, before the Fed started raising rates, we were at 83. This is very omen of what is to come. Let's look at a 5-year. Post the 2020 crash, we're lower than where we're at today. Going back to 10 years, let's do 25 years. So pre-2008, we're not quite there yet, but we're in 2005, shortly started tailing off after that. So be ready, because we're tailing off now, right? Housing. Next, we got Michigan sentiment. That's just a survey of how the households are feeling. We're at 60. It's trending up a little bit, but the fact is, it's below 60. And look where it was. Even after 2020, 25 years. 2000 bear market, 2008, we actually dropped below that. So it's like this sentiment of negativity is happening currently. And just recently, we're in Q4 2022, budgets occurred in the United States of America. So most corporations went through and they redid their budgets, and this is going to impact who they're hiring, right? Or who they're laying off, or who they're hiring freezes. The tech companies already started laying off, so there's going to be a lot of pressure going on. And this Michigan settlement gives you an idea, even though this is households, but it stems across the boardrooms as well. Next, you get in credit card debt. It's really started shooting up once interest rates started going up. Layoffs, not using home equity line of credits, interest went up. So you could have HELOC 3%. Now it's like 6-7 probably percent. So those payments have probably doubled many households. So they're like, okay, where could we find additional finances? Because everybody likes to spend. And inflation is real. So costs are going up. So you got to offset it somehow. It's simple math. From a standpoint of economic news, we'll talk about this as well. Sorry, I'm going to turn this music down. The economic news of the week, there's always key things. I think housing starts is, it's a no-brainer how the numbers are going to look. So housing starts is a critical number to watch. We saw that the housing index came in by the home builders, and that came in at 31. That was very negative as well. So we're going to have housing. You get towards the end of the week, we get in, more about us humans in the United States of America, purchasing goods, durable good order, month over month, stuff like that. And then we do get into Michigan sentiment as well. And then we get into next week. I have China on here because there's very little Chinese information coming up this week. And then if we get into next week, we got some PMI, Purchasing Manager Index. So it's a sentiment for manufacturing as well as non-manufacturing in China as well. That's critical because China is opening up. They have COVID issues, but they will open up, and they drive a lot of the world growth, historically, demand, supply and demand. And so that's important to watch. Let's talk markets. This is New York Stock Exchange. It's a simple chart. I have a moving average. I'm into technicals as well as fundamentals. I follow an approach of using everything that works at, if you look at some of the best hedge fund managers ever, they would follow technicals as well as fundamentals. And I used to work in that industry as well, so I understand. I've met with some of the greatest hedge fund managers in history. Understand what it takes to make money. It's all about managing risk. But if you don't have the big picture cycle right, and you want to be going long during a downtrend, it's usually not the smartest thing to do. You could buy value. You could hold long enough, you might be able to come out on top, but you got to still look at big picture cycles. In the early 1900s, the average PE was 10, say, approximately, and we're up around 18. So there's a good probability that price earnings may come back a bit, especially on the tech side. And then given the amount of buybacks over the last decade in the United States of America, that will not be able to continue because of the cost of capital is going up. The cost of debt to purchase, finance, get money from a bank has gone up. So the buybacks are going to decrease. Companies that are losing money are likely not going to be able to continue that glide path because banks are tightening up. Everybody's tightening things up right now. So you're going to see some bankruptcies. Venture capital firms are going to be in trouble. This is just getting started. I work for a startup. And I trust me, I feel what's going on, and this is, a big startup. Let's keep moving. Apple. I pulled this up because Apple's the same thing. It's just like New York Stock Exchange. You could see it turning over. These ribbons in here I just found fascinating. I was looking at them the other day, and they're actually 3-dimensional ribbons. And without spending too much time, you can actually gain insight on them because it's actually a 3-dimensional wave going on. Then it flips here as the cycle turns up. So you could look at the the depth and breadth of this to really gauge cycles. I have some indicators I use. I don't use this actually, but this is just visual for buy and sell signals. And it is fascinating because you can see we got this crazy down wave, then we push up, slingshot up, then now we're getting like this momentum of energy building up here. And yeah, Apple is going to get toasted. Apple, they bought back about approximately $128 billion of stock since 2012. Their total debt to capital or equity has gone from 60 to 70 to 80%. They have a lot of debt. And their ROA, ROI, all those numbers are amazing. It's almost too good to be true, honestly, when I look at their numbers. But the fact is, debt is what has driven their growth in their stock, and that is ending. So, strong sell in Apple. Now, saying that, the Federal Reserve could hypothetically come in Q2 and say, oh, we're going to cut. But guess what? They're not going to do that. Why? Because Powell has been very clear. They've all been, Bill Dudley, you name it, on their approach. They're going to, the terminal rate, their target is 5.25%, I believe. They want to have ability to drop rates if necessary. And the fact is, inflation, they want inflation to run hot. They want growth to run hotter. And they're going to peg rates low. And they're going to pay off our debt using this methodology. And this is the glide path to that. So it's what they must do. So in order to do that, they're going to have to raise rates. Jobs made, the problem is they got to get inflation down. And they have. If you look at wood, if you look at most of the commodities, they've all turned down. The area where they haven't been able to control inflation is with the psyche of the people, because you go buy a Christmas tree and it's $1,500 for a 12, 15-foot tree, and last year was $500. That's a problem. On the services side is where there are issues. Accounting firms, people that can control their costs really easy, or they're feeling the pinch all over, and so they're raising costs and they haven't started. Companies like Pepsi, they raise prices to a certain degree, and now they're laying off as their stock hits a 52-week high. So but the focus of the Fed is like, okay, services. So they got to find a way to like squeeze these small businesses. That's really their target. What is this? And so this is where we began. I do have a Green Bicep Twitter channel, Signal from Noise. And it helps me lay out my thoughts. So let's get into the VIX. So the VIX looks at the volatility. I believe it's calculated using the amount of options purchased, puts and calls, and activity on that. And ultimately, it's just a great indicator to know risk on, risk off, meaning, it's the way I use the terminology. Risk off means you want to be out of the market. And so if I could put the market trend over this, and it would look quite similar how the market, it's a sine wave essentially. And so with rates being raised now, we're in we're risk on, but we're going to risk off, meaning smart money is starting to leave. There was risk on. Without confusing anyone, let's just put it this way: money has been leaving the market and trying to find places to hide, and that gets to the yield curve. And so if you look at the yield curve, we have an inverted yield curve, and that ultimately means on the short end, meaning if you wanted to get a bond that's short term, you're going to pay a risk premium because there's risk embedded in assets right now, specifically bonds, stocks, you name it. You're going to have to buy a safer security. You got to pay extra for that because you're more protected. I don't know. You could argue how the risk premium, the psychology of it, but the fact is money is being parked elsewhere rather than short-term bonds. Otherwise, rates would be going down, and that money is probably being parked in cash or potentially long-term bonds or elsewhere. So let's I'm going to read this 8 trillion fund issues warning. We'll skip over the crypto crap. And basically, BlackRock, recession is foretold as central banks race to try to tame inflation. It's the opposite of past recessions. Central bankers won't ride to the rescue when growth slows in the new regime. Investors, and that's what investors expect. Equity valuations don't yet reflect the damage of it ahead. This is one of the largest investment firms. So currently the signal is because of this inverted yield curve and interest rates going up, we have to reevaluate stocks. How are stocks priced? If growth is going to slow down, the price should come down, and much of that was not provided or put to the forefront most recently. Meaning in Q4, the companies did not. The companies basically didn't change their guidance. So you're going to see in Q1 companies pulling down guidance on stock prices and their forecast, revenue, margins, all that. And that's when you're going to see the market get like wiped out in many different areas. So that's what we have to be prepared for. And so I'm just going to run through my notes. Yeah, so the signal for this session here is that we are in like the first phase of a bear market. The market is going to reevaluate stock market specifically next year, and companies are going to come out and give guidance. Guidance is likely going to be adjusted down, so you're going to see multiples change. PEs will be readjusted. So P's will drop. And because of that, you're going to see stocks roll over. So I'm just trying to scream from this mountaintop that the market's going to roll over pretty hard. There will be opportunities. You're looking at gold and copper, commodities. Inflation-heavy areas are doing fairly well currently. So that would be my current focus now. If I were to allocate capital, copper and gold are my two favorite areas currently. So in closing, let me give you I should have done it at the beginning. My background: I got a degree from Fordham, UCF Finance, worked in the hedge fund industry in the early 2000s through 2008, interviewed Mario, worked with different hedge fund managers, David Einhorn, John Paulson, Two Sigma, Mario Gabelli. So I get it, what it takes to succeed in a market. Day trading, you can do it. You got to use the right signals, and techniques. But if you never were mentored by someone, I wouldn't advise to go that route. All right, I'm going to close this one out for now. Cheers to episode number 1 of Green Bicep. For things to change, we'd want to see housing start to turn around. Durable good orders start to really shoot up. Profits improve and unemployment. But in the current state, housing's turning down. Orders are lackluster. Profits have been so-so, but margins are starting to get squeezed. That's why you're seeing stocks gap down so much in this last quarter. And I think next year is going to really shock a lot of people. So the word is hope, and that's from Cantro on Twitter. And then it's housing, orders, profits, and employment. And currently we're at the employment stage where the Fed has been unsuccessful in getting the employment numbers and wage inflation to drop so they could target services. And so that's where we're at. Bottom line, they're not going to stop. So, buckle up, be prepared. I'll continue to try to find opportunities of where we can make money, because the goal here is actually to make money, to educate, to learn, and have fun all at once. Thank you. Cheers.